Hey guys, welcome back. Coming to you from Tennessee. Sorry for the late video. I've been on the road today, but I had to get out some thoughts about what we saw in the memory sector today. It was another tough day for the Fab 4 overall. We saw this week exactly what you're looking on the screen right here is the NASDAQ 100 1-week change. Just take a look at what we saw across the memory titans. Micron was down by almost 20%. SanDisk down by over 25%. Western Digital and Seagate were both down by over 20% in the 1-week change. So this was a tough week, a tough couple of trading days for the memory sector overall. I think any investor in his or her right mind would have their confidence rattled for what we saw over the last couple of trading days. You could easily understand if someone had lost their conviction overall. But we saw a number of bearish headlines that just directly attacked the sector, directly attacked the memory titans overall. Everything from today, we saw Michael Burry come out with a direct short position against Micron. He announced it earlier on his Substack. We know that he already had a short position against the SOX ETF, but he specifically called out Micron today. We also saw the lawsuit that keeps coming up in headlines over and over again. I think it's driving some of the selling pressure for Micron and across the sector overall. But we saw a multi-billion-dollar structural shift also happen in Korea and Taiwan. This has been the bearish narrative has never been louder in the memory sector than what we saw this week. So there's no question we were going to see some profit taking and a bit of choppiness today. You know, in my video last night, I mentioned we would see a gap up, but don't chase the initial green candles because I just felt we would see a sideways digestion, some choppiness, and profit taking into the closing bell. I felt like these stocks would be down today, not as aggressively down as we did see today. I thought we would pull back leading into the holiday weekend. It's what we saw, but it's at a much more aggressive scale than I anticipated. So on this channel, you know, we don't blindly defend the memory sector. We don't blindly defend any sector for the matter. What we do is we strictly follow the signals in the market. We let the signals lead us to where the market may be going next. And we have to ask ourselves this fundamental question. Has the memory thesis actually broken? Or are we watching Wall Street temporarily lose confidence in one of the strongest businesses in the semiconductors? Today, we're going to act as an unbiased investigator. We're going to look directly at the core themes driving this week's bearish headlines. We'll put them directly under the microscope and against the latest institutional data and evaluate whether the underlying structural thesis for the sector is actually broken or has it remained strong as ever. So that's what I want to cover in today's video. If you haven't done it already, though, make sure you hit like. Make sure you subscribe to the channel. Guys, we're growing in leaps and bounds. Thank you to each and every one of you for your support. If you like these videos, if you've learned something on this channel and you haven't subscribed yet, though, do me a favor. Take a moment, hit subscribe now. All right, guys, let's get started. Let's take a look at the bearish headlines that affected this sector this week, drove some of the sentiment overall, the negative sentiment overall for the sector. So let me pull up a picture that I made to just capture some of the big themes overall. Now, it doesn't have all of them. You'll see that I don't have the lawsuit in here. I probably don't have some of the other ones, but I did try to capture the bigger themes overall. And you can see on the left, I want to start off with the Michael Burry story. That was probably the newest one today, the direct call out to Micron. This was essentially a vote of no confidence from one of Wall Street's most famous contrarians. Michael Burry dropped a bombshell in a Substack disclosure, confirming that he has officially opened a direct surgical short position against Micron. As I mentioned, we know that he already had put options against the iShares semiconductor ETF SOX, what was already announced earlier in the week. But this news around a Micron was a new article, a new headline today. It definitely drove some of the selling pressure against Micron. His core thesis is simple. He argues that the Philadelphia Semiconductor Index is sitting at an historic extreme. It's trading more than 65% above the 200-day moving average, a stretch that we haven't seen since the dot-com peak in 2000. But for Micron specifically, Burry is essentially asserting that Micron is the only pure-play DRAM company on major U.S. exchanges. So therefore, it makes it uniquely vulnerable to massive overvaluations during AI hype cycles and to violent downward corrections when supply inevitably catches up. The bear camp saw this headline and they celebrated as a proof that the smart money is calling out a top on memory. Michael Burry is essentially betting against a macro valuation chart. We as investors, we are investing in a structural global chip deficit where tech titans are literally pleading for blacklisted hardware just to keep their data centers alive. Burry is playing a short-term volatility game. We are anchored in a multi-year cash flow supercycle. So in my opinion, let the algorithm panic. Let the algorithms panic over the big short headline. It's just handing us an institutional buying window at a steep discount for these companies overall. The second fear that I want to talk about today, you see in the middle there, it's all around the global supply expansion and kind of pricing destabilization. So this is really just focused on it's a combination of a kind of few geographic shifts. First, we saw SK Hynix. They filed for their massive NASDAQ ADR. It's actually next week on July 10th. They're going to be under the ticker of SKHY. I may do a video just to show you how you get into that, the impact on the sector, what it might do for Micron. Will we see capital rotate out of that? So keep your eyes on that for the weekend. But it definitely had an impact on the sector this week. They're looking to raise $29 billion. At the same time, though, they're standing alongside the South Korean president to announce a combined $520 billion investment with Samsung into a regional southwestern memory hub. The bears looked at this $500 billion capital expenditure, and essentially they got worried about a supply glut, an overcapacity, a significant of oversupply into the market, and the impact that it would have in the memory sector overall. And this fear was definitely compounded by the headline risk that we saw out of Taiwan and China. So reports, and I mentioned it on the channel actually, that TSMC is officially, although it hasn't been officially announced, that they're collaborating with Winbond Electronics to build a localized custom DRAM supply line using 3D wafer-on-wafer stacking technology to move specialty memory closer to Logic's chips. Simultaneously, we also saw this week that Apple is negotiating with blacklisted Chinese memory manufacturers like CXMT to source cheaper DRAM for localized products. So the bear thesis here argues that between the South Korean overinvestment, the localized Taiwanese packaging, and the consumer tech giant like Apple attempting to leverage cheap Chinese memory backdoors, that domestic tier one manufacturers like Micron will lose their tight grip on global pricing. And then finally, on the far right, you'll see this pillar or this fear is all based around the custom silicon architecture that we're seeing in the market. So we are seeing noise that OpenAI is officially unveiling Jalapeno, its first custom inference ASIC co-developed with Broadcom. It's optimized to run models at tight physical limits. The same time, we also saw Anthropic make headlines because they have tapped the elite silicon engineers and entered into an early stage negotiation with Samsung Electronics to manufacture custom AI server chips on their 2-nanometer process node. The bear argument here states that as the world's largest infrastructure buyers in OpenAI and Anthropic, if they move to custom computing platforms, they will dictate specialized architectures that will cut out the high-margin commodity memory and storage footprints traditional merchant sellers rely on. So those were the big fears in the market overall. I think those are the big themes. I'm sure, like I said, I'm sure there were others I didn't capture. There were a lot this week that hit the sector that drove it down overall. But those, in my opinion, were the themes that are probably keeping the majority of us investors up at night. But here's the problem. None of those headlines actually change the numbers that we see with Micron. Because if we step back, we have to realize that the earnings that Micron dropped on the street were only 7 days ago, essentially. They dropped those fantastic Q3 earnings onto Wall Street last Wednesday, a little over a week ago. We saw significant selling pressure over the last couple of days. It kind of reminded me of the Q2 drop. We saw the pressure immediately after that earnings drop. We did have a couple great days after this one, but it seems like with all the bearish headlines, we're getting hit right now. Micron is down by 20% over the last week. But if we think back of what the Micron CEO actually shared with us during that time last week, we have to ask ourselves one fundamental question. What changed in the last 7 days? I want to pull that back up and just walk through some of the highlights overall. So I'm going to pull up you can see the guidance that he gave. But before I go through the guidance, I just want to recall a few things, a few points that the executives laid out. First, you can see Micron, or the first thing I want to call out is that Micron revealed that its data center business has officially exceeded $25 billion in revenue for the quarter, placing the segment on an annualized run rate of over $100 billion. They also mentioned around the shift to the agentic AI, and that this shift was driving a massive 30 to 40% annualized expansion in CPU memory intensity. The executives and management also confirmed that their leading edge, their HBM capacity is 100% sold out through the entirety of the calendar year 2027. And it's backed by a staggering $22 billion in upfront cash deposits and long-term buyer commitments. But look at the guidance that you see on your screen. Now, I want to jump into the guidance we see because they have locked this in for the upcoming quarter. Micron guided to a revenue of $50 billion, an historic level for this company. They projected non-GAAP gross margins climbing to an unprecedented 86% for a hardware company. And they laid out an expected single quarter diluted earnings per share of $31. So think about the math here. The stock price is taking a temporary beating while the underlying operating company is actively accelerating. When we audit the memory and the storage trade against this data, our long-term fundamental thesis, or for me, why I have conviction for Micron long-term, it rests on three core pillars overall. And I made a picture to walk through that as well. So let's go through it together. This picture's a little busy, so I'll just speak to it overall. But I want to talk through the three kind of pillars. The first pillar you'll see, it's all around the contract architecture we see now. So historical bear thesis, particularly like we saw with Burry, talking about Micron being a deeply cyclical commodity player, memory being that way overall. I think that era is functionally broken. We've talk about that on the channel. Tier 1 manufacturers like Micron and SanDisk have systematically shifted their business models towards these multi-year long-term agreements and new business model frameworks with cloud service providers. Bernstein recently upgraded SanDisk to a street high 3,000 price, the 3,000 price target, specifically because of these structural changes. These contracts feature upfront customer capital deposits and floor and ceiling pricing mechanisms that isolate gross margins. Even if the broader consumer market cools, these contracts guarantee an insulated high margin revenue base through 2030. For the memory players, for Micron and SanDisk overall. In the middle, you still have pillar 2. It's all around pricing power and structure on their supply. The market is panicking over future capital expenditure plans, but the near-term cash generation is locked in. Bank of America's latest data confirms that structural supply and demand deficit in the enterprise NAND and flash markets will persist cleanly through calendar year 2027. Supply chain contract data from KeyBank, we talked about it the other day. It shows that pricing power remained robust through June. DRAM contract pricing was up 3%. NAND was up almost 2.5%. Tier 1 manufacturers are maintaining complete supply discipline, keeping GAAP gross margins insulated at historic levels, with Micron at about 85% and SanDisk pushing 81%. Demand isn't dying. It is actively overflowing. Apple's attempt to look at alternative Chinese suppliers isn't a sign of weakness for the sector. It is an act of desperation by Apple because enterprise buyers have completely hogged Western wafer lines for high margin server configurations, choking out the consumer allocation. And then finally, on the right, my third pillar overall is while the HBM memory, it captures the headlines, the massive explosion of data center logging and enterprise LLM checkpointing is transforming the mass physical storage footprint into an absolute cash machine. Western Digital, which operates as a pure play hard disk drive giant, is capitalizing heavily on a structural cost per terabyte advantage. The company is preparing for a massive volume ramp of its next generation 40 terabyte ePMR hard drives later this year to feed data centers running out of physical footprint. The historic trend of storage price dropping 10% annually has completely inverted. Average selling prices rose nearly 9% year over year last quarter because hyperscalers are desperate for physical capacity. Furthermore, look at the custom silicon chips like OpenAI's Jalapeno and Anthropic's 2-nanometer project with Samsung. Those logic chips are designed to bypass NVIDIA's high markups, not memory or storage blocks. Those memory and storage still have significant play in those architectures as well. Hyperscalers can design whatever proprietary compute engines they want, but they still have to pay the structural data movement tax to the companies that own the physical memory and the storage supply chain. Now, before we move on, we do have to ask ourselves a question, or we have to I want to make one thing kind of crystal clear. Conviction should never become stubbornness for us as investors. We have to be willing to change our minds when the data changes or the signals look different. So what would actually make me kind of consider changing my view on this entire thesis? First, if we start seeing widespread HBM order cancellations or hyperscalers cutting memory allocations rather than expanding them, that would make me change my mind. Second, if we saw DRAM or NAND contract prices begin rolling over for several consecutive quarters because supply was finally overtaking demand, that would also make me change my mind. Third, if these new long-term contracts or agreements stopped expanding, or if customers began walking away from price structures that Micron and SanDisk have spent several years building, I would have a change of mind. And finally, if management teams across the industry started lowering guidance instead of raising them, I would definitely change my mind. Those are the signals that would matter to me. But when I audit the data in the market today, I don't see any of those signals happening right now in the market overall. The fundamentals, those all remain incredibly strong. So I don't see a change. I don't see a bearish sentiment overall. My conviction remains strong. So if the fundamentals are so strong, why did we see a 20% drop in Micron, a 25% drop in SanDisk, and a 20% in the storage titans this week? We must decouple business execution from institutional market mechanics. The sudden drop in stock price wasn't a structural breakdown of the memory demand. It was a textbook display of institutional positioning and macro risk management. I think the first factor was that semis have been the single most crowded trade in the global marketplace. The SOX ETF, it's been up massively year to date. When macro funds, when they see an index sitting 65% above its long-term moving average, portfolio risk mandates trigger automatic profit selling. And the second piece was the kind of legendary short seller, Michael Burry. When he explicitly names an individual stock like Micron for a direct short, algorithmic trading desks don't wait to read the underlying financials. Programmatic sell orders trigger almost instantaneously, cascading through stop losses and forcing leverage retail liquidations. And then the final piece overall, I just think that large institutional desks routinely trim high multiplier tech exposures at the turn of the quarter to reallocate capital into defensive sectors or lock in gains for their quarterly reporting. Institutions aren't dumping these shares because they think Micron's $50 billion guidance is a lie. They are managing short-term portfolio risk in a highly visible macro volatility window. So guys, in closing, every great secular bull market experiences moments where price action temporarily disconnects from the underlying businesses. The question investors have to answer isn't whether the stock fell this week. It's whether the reasons they bought the business or the stock in the first place have actually changed. If your investment thesis was based on chasing short-term chart momentum, then a macro index short or a dynamic headline will break your conviction every single time. But if your thesis is anchored in the physical laws of hardware bottlenecks or the constraints that we see in the market, the transformation of contract models, and the exploding requirements of agentic AI architectures, then the structural destination remains entirely intact. That is the fundamental data that I continue to track every single day on this channel. Let the market take its short-term breath. It's actually really healthy for the sector overall. The structure tells us that we will continue to see a reset and a movement back with these stocks in a positive manner, just based on the demand and the fundamentals and everything we know and love about these companies overall. So guys, a tough week, but I think next week we will get back to a bull run again. We'll see positive momentum again for these stocks. Don't let it rattle your conviction. Don't let it make you lose these stocks overall. Don't let them shake you out of these core positions. That's just my thought. But remember, just manage your risk individually. Make sure you make your own decisions. Those are just my thoughts and my opinions overall. But guys, have a great night. I look forward to seeing you in the next video. Take care.